Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 110, we're going to look at a case for the retained interest ILIT. Now, I haven't really dug into whether this is a concept that's been used by other practitioners. This is more one of those back of the napkin ideas I had in sitting here brainstorming, but wanted to run through a list that's not necessarily all-inclusive of some of the benefits and potential issues that could pop up with this and why we might look at this type of trust. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, traditionally, life insurance was used solely to generate a death benefit, and that liquidity was designed to fulfill the needs of the family or the estate from a tax perspective. So with that, the most in vogue planning technique was the irrevocable life insurance trust, also known as the ILIT. Now, I've talked about ILITs in a number of my past episodes, so just as a quick review, the entire intent of the ILIT is usually estate tax based, in that it avoids the taxation of the death benefit, which would otherwise occur if the death benefit was payable to the insured's estate, or if the insured had transferred incidents of ownership other than by bona fide sale in a policy within 3 years of death. Now, the problem with that type of arrangement is that increasingly life insurance policies are also being used for lifetime benefits for the insured and the insured's family. And with this type of arrangement, typically the insured has to give up all economic rights to the policy in order to achieve these estate tax savings. And if a cash value policy is used to fund an ILIT, if the cash value is significant, there might be a higher gift tax value or sale price in funding that ILIT. So when we dig into the lifetime use, we're usually looking at one of two mechanisms. One could be the insured withdrawing cash surrender value, which is usually subject to income tax on a FIFO basis, meaning that your premiums are returned before you're taxed, unless the policy is a MEC, a modified endowment contract, in which case you're taxed on a LIFO basis. Then you could also have policy loans, which are tax-free, but accrue typically above market interest and will often reduce the death benefit that's payable. Now, if you're really digging into this, you might kind of look at, hey, there could be some benefits to be gained even with the retained interest. So what if these benefits were preserved maybe just for the trust and its beneficiaries, and the beneficiaries might include the insured? In that case, on its face, you know that the beneficial interest of the insured, or if there is a prevention of a completed gift with a special power of appointment, either of those by itself would each be a retained incident of ownership, which would subject the death benefit to estate tax. But could that estate tax issue be reduced if the trustee were to borrow against the policy and accrue significant policy loans prior to the insured's death, thus creating a pool of cash in the trust that could be distributed and creating an offset against the taxation of the death benefit itself? It could be a good option, but with the insured as a beneficiary, you have to dig into whether there's a retained interest under code sections 2036, 2037, or 2038, which might not be the case if there's a bona fide sale of the policy, but could be the case with a gift of the policy. So, digging into this, I'm going to look at two quick rundowns of problems that could arise, one being income tax issues and the other being transfer tax issues. With income tax issues, to avoid a lot of them, you'd either have to have the trust purchase a new policy or have the insured as a grantor gift existing cash value policy to the trust itself. So, the reason you want a grantor trust is because if it's not a grantor trust, any sale of the policy to the trust to fund it would be a transfer for value, which would mean the entire death benefit could become subject to income tax. Because remember, our exception is a sale to the insured, and in order to have a sale to the insured would have to be a grantor of the trust here. So that might be an issue, but again, that could potentially be offset by policy loans in terms of how much death benefit is paid and is thus subject to income tax. So it depends on the growth of the policy as to whether that's a good idea. Now, Most of the time, you'd have a grantor trust because use of the trust income to pay premiums on the grantor or the grantor's spouse would make this a grantor trust. So a big question might be, could the spouse of the insured instead sell the policy to the trust? And that might avoid the 2036 and 2038 issues. But with that, would the use of cash value to pay premiums also be taxable to the insured as a grantor if you dig into the LIFO or FIFO type of analysis? And then finally, if this is intended to be an asset protection trust, you might have to hire a trustee in a domestic asset protection trust state, and the insured as grantor or beneficiary might be liable for additional state income tax depending on the type of trust. And with that, I also want to mention you want to avoid the Goodwin situation, the ABC situation within the trust itself to avoid additional income tax. Now, from a gift and estate tax issue, there's a couple layers. One, 2042 comes into play, Code Section 2042, which typically taxes death benefits if the insured retains an incident of ownership at the time of death, or under Code Section 2035 if one is transferred within 3 years of death. So in that case, first off, the grantor's beneficial right would be an incident of ownership potentially, or it could be a reversionary right under Code Section 2042, meaning the death benefit would be subject to estate tax. As I mentioned, the estate tax issue could be offset by policy loans, maybe not in full, but in part. But the policy loans themselves also create trust value if the loan proceeds are not distributed to the grantor insured. And if that trust value is subject to estate tax due to the insured's retained interest under Code Section 2036 or 2038, you avoid the benefit you get with that offset through the policy loans. Now, note that if this is an incomplete gift trust as well, it would make it subject to estate tax in full. So you need to look at that gift issue along with the upfront gift. If it's an incomplete gift trust, that's not an issue, but the upfront gift, if it's a completed gift trust or the seed money for a purchase, could be significant in order to fund the trust itself. And GST allocation might be needed to the extent the trust is funded by the gift itself. And if the trust is an incomplete gift trust, you have to look at whether distributions to beneficiaries might be subject to gift and GST tax. And even with a completed gift trust, the payment of premiums would similarly be subject to such taxes. And finally, trust level policy loans are really deductions that the trust is entitled to and not the insured as a beneficiary. So if these policy proceeds are included in the insured's estate as assets, then the estate might not be eligible for an offset for policy loans if the policy loans didn't net out at the trust level the taxable portion of the death benefit. And even if they did, you still have the policy loans that couldn't offset any amount included under Code Sections 2036 or 2038. So lots of little issues here, but this might be a good way to look at funding an ILIT and allowing the insured to retain an interest and maybe gaining some additional asset protection in states where the amount of cash value of a policy that could be protected might be limited. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.